Hey, James, can you hear me? Hello? Hello? Can you hear me?
Yep.
All right, I was just calling your cell phone.
Oh, yeah, I'm running late. All right. You see the presentation?
Yep. Can you scroll? Yep.
All right. And it is go time.
All right.
All right, I'll go ahead and hit start. You gonna mute?
Yep.
Okay, good morning, everyone. Good afternoon, some places. I'm gonna give it a quick minute to let the attendees populate before I get started. All right. Looks like it's stabilizing a little bit. I'm gonna go ahead and get started. All right, so my name is James Bogart. I'm CEO and president of Bogart Wealth. I wanted to start. My heart goes out to everybody in Texas right now. I'm hopefully there's not a whole lot of damage and people are able to get through these tough times. For today's talk, I'm going to be talking about the retirement planning timeline. I do have the chat box open as well as the question and answer box open. We are recording this webinar as well. So feel free, ask any questions. I'm going to do my best to answer it. And this is one of those seminars that we've been doing for a little while now. And I'd say we cover a lot of material, but really do get very specific on a couple of these certain things. And then anything that you'd like to ask, just feel free. All right. So just real quick, wanted to introduce Bogart Wealth. So Bogart Wealth is a registered investment advisory firm. Our core competencies are financial planning, investment management, tax optimization, as well as tax preparation. We are managing about $1.35 billion of client assets. It's approximately 800 households, roughly. We are true fiduciaries for our clients. It means that we're legally obligated to put your interest above our own. No hidden agendas, no conflicts of interest. There are now 19 folks on my wealth management and planning team, as well as 4 on the tax team. We have 3 different office locations, one in McLean, Virginia, one in Houston, Texas, as well as one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. What we found is your kids and your parents can be some of the largest variables of anyone's financial plan. We've made it part of our firm's culture to give your children or parents access to us. And, really, we just know the impact that we can have, especially for the kids at a younger age, and really encouraging some of the behavior that we'd like to see. I like to commonly will ask you the question of, What would you do differently now that you know what you know, but if you were in your 20s and 30s again? And then one of the calls to action from any of the events that we do is to actually offer the opportunity to sit down and run your numbers. It's absolutely no cost, absolutely no obligation. Really does give you a good assessment point for where you're at, and then any course corrections or adjustments we should be making along the way. So today's talk is part of our retirement readiness series. This is something we've been doing for several years now, and we continue to expand it. We continue to add new content. But the first event that we started doing is the retirement planning timeline, which is the one we're talking about today. And then we also do one on retirement income planning, one on Social Security and Social Security strategies, one on tax and tax optimization strategies, one on estate planning strategies, one on net unrealized depreciation and post-retirement income strategies, one on long-term care and long-term care insurance, one on Roths versus traditional 401ks and IRAs, and then last but certainly not least is one on mega backdoor Roth conversions. You know, this list came from our audience, so if there's something that you'd like to see added, at a minimum, I'm going to add it to one of the existing events, or I'll make one all on its own for that. All right, so let's just dive into today's talk. Now, for today, we really are going to focus on the retirement planning timeline itself. And with that, we are going to start with things that we need to look at when we're over a year out. Then we're going to look at when you're within a year, right at retirement, and post-retirement. I'm going to use several examples for the ExxonMobil programs. It does apply to other companies, and obviously part of this whole conversation really does hold true in terms of the core tenets. And so what I mean by that is, you know, when we talk about over a year out, this is the time that we really do believe you need to know your rules, whether it's a pension program, tax laws, 401k, et cetera. But we also need to know and understand what investment choices you have available to you. Understand your savings plan and 401k, and run your numbers. Do a plan. If anything, I encourage to do 2 or 3 different plans. This is a great opportunity to interview different advisors. This is also perfect time to evaluate contributions, not only how much, but where, and be saving efficiently and effectively. And I would also say, if you are entertaining hiring an advisor, a great opportunity is to establish some kind of what we would call trial relationship with them. Get comfortable with who they are far before you're retired. And now all of a sudden you've got all the money that needs to be addressed or managed. All right. So the first thing I want to talk about was understanding some of the rules, and specifically talking about the pension program. So in 2006, the Pension Protection Act was established, and this actually created a whole new series of rules that had an impact for ExxonMobil employees, but a lot of other companies as well that had defined benefit programs for their employees. Now, what the Pension Protection Act did in 2006 was it limited companies that were offering a lump sum option within their 401k plans. It also clearly defined the discount rates that are being used to calculate that lump sum option. It also defined the actuarial table that's going to be used. And then a couple things not necessarily related to the pension and lump sum option was they clarified that non-spousal beneficiaries can do rollovers. They also clarified that after tax balances can be rolled over to a Roth IRA. It also clarified that company matches can be diversified. So many of you might remember, for example, at ExxonMobil, in order to get the extra 1% match on the 401k plan, you had to have it all go into company stock. Well, after 2006, they still had the extra 1%, but it didn't have to go to stock. And then the other thing the Pension Protection Act did was it defined IRA as well as 401k contribution limits. So the first thing I wanted to describe and using it as an example, the ExxonMobil program, there are 2 categories of households within the ExxonMobil program. One that's called the grandfather, which is essentially meaning their grandfather prior to the 2006 Pension Protection Act. And these were individuals that were over the age of 50 at the end of 2007, had more than 10 years of service before January 1st, 2008. And you use the old rules. Now, this was anyone who was 55 and had more than 15 years of service by December 31, 2012, or more simply, you were born before 1958 and hired before 1998. Now, the math for this age group is actually very simple. You use 95% of the 30-year treasury rates. We round up or down to the nearest quarter point. The other thing with this age group is we use the ExxonMobil year 2000 mortality table. Now, what we know for the grandfather category is that the first quarter was at the lowest level it ever been at 1.25. It did move up to 1.5 for the second quarter. And based on what the 30-year treasury rates are doing now, it looks like it's going to go up to 1.75 with a slight possibility it might even go all the way up to 2.0. So treasury rates have definitely started moving back up over the last couple of weeks. Now, the other category, this is everybody else. This was those that were under the age of 50 as of December 31, 2007, or you were born after 1957 and hired after 1997. And for this age group, it's actually a little bit more complicated. You use three segments, segment 1, segment 2, segment 3, that are all based off of high quality corporate bond rates. Now, corporate bonds historically have been higher than treasuries, so the rates are higher. But the other thing that this age group does is that we use the IRS mortality table, which is released every single year, and people are living longer. Now, for the non-grandfather category, we know that the first quarter of 2021 it was the lowest it's ever been. Second quarter, it stayed exactly flat. And we're now doing our projections for the third quarter. And it does look like, by all indications, we're seeing a slight rise. Our models are showing about a 14 basis point increase going into the third quarter. Now, with both categories, we do a weekly email where we publish what we're projecting the discount rates to be. If you would like to get on that list, just send any one of us a note. We're delighted to add you onto that. Gives you a nice baseline of where rates are going. What I will say too is the whole decision around lump sum versus annuity, it's only one part of the many decisions that we're going to have to make regarding retirement. And it really does build into the timeline itself and understanding what some of those critical dates are and timing and when we need to be executing. All right, a couple other things related to the Pension Protection Act, and it's understanding your 401k contribution rules. Now, there wasn't a dramatic change from 2020 up to 2021. We do know that we can, if you're under the age of 50, you can put $19,500 into your 401k on a pre-tax basis. You can also do a $6,500 catch-up contribution. Now, all in on the plan, you actually can put $58,000 total in, plus an additional $6,500 to catch up if you're over the age of 50. This was a slight increase from 2020. 2020 had a total of $57,000 plus $6,500. That's the only thing that changed in terms of 401k contribution limits. And so I've had a lot of folks say, hey, well, I actually max out my 401k at the total of $26,000 a year. And I'm saying, well, actually, that's not technically maxing it out, because if you're over 50, you could put a total of $64,500 in. I'm going to talk a little bit about that in a minute and why that has impact. But again, understand where you're saving, how you're saving, and we really want to be deliberate in terms of that action plan. Now, related to 401ks, there's also IRAs. We'll talk about IRAs and Roth IRAs. But with IRAs, they did not change, IRAs, and Roth IRAs, they did not change contribution limits for 2021. So you can do $6,000 if you're under the age of 50, with an additional $1,000 of catch up if you're over the age of 50. Now, a lot of folks ask us the question, what's the difference between an IRA and a Roth IRA? Well, an IRA is where you put money in on a before tax basis. It grows tax deferred, and when you take the money out, you pay ordinary income taxes on it. Now, Roth IRAs are where you put money in on an after-tax basis. It grows tax-free, and assuming you're over the age of 59 and a half, and that Roth's been in existence for 5 years, all of that appreciation is also tax-free. So you can probably imagine we're very biased on getting as much into Roths as possible. However, there's some strings associated with that. With Roths, there's only two ways of getting the money in there. The first is that you make under a certain income threshold. So for example, with married households, it's $208,000 in 2021. The only other way of getting money into a Roth is through conversions. means that we need to put money either into a traditional IRA or a 401k and then convert it over in order to be able to do Roth. But in order to do a Roth conversion, it means that we are going to pay ordinary income off of the amount that we convert. And so for a lot of employees who are finally at a place in their lives when they have discretionary cash, they can do some more savings. Typically, they're at a higher bracket, at least higher than where they're going to be in retirement. And so it doesn't always make sense to load up Roths when you're in these high tax brackets, because again, it's going in on an after-tax basis. Typically, we'll want to talk about strategies and ways of saving and optimizing in order to utilize these, but we might not ultimately look at doing Roth conversions until someone's retired, because that's when their tax brackets are going to be lower and it makes a lot more sense. So some rules with Roths. Now, as I mentioned, they are tax-free growth as well as tax-free withdrawals if it's been in existence for over 5 years. Another really nice part about Roth IRAs is they are not subject to required minimum distributions. Now, for anybody who doesn't know what an RMD is, required minimum distribution is, that's when you turn the age of 72, you're required to start taking out a percentage of IRA accounts, 401k accounts, as well as Roth 401k accounts. And that percentage increases every single year. And so what can happen is if that percentage is causing the amount that you're required to take out, and remember, when I say take out, you're taking a distribution, creating ordinary income. But as that percentage increases, that can actually drive your tax rates higher more than you'd like them to be. We call that RMD prison. Another couple things with Roth IRAs, beneficiaries can inherit tax-free growth. It does provide for some tax diversification. And it does have the big caveat that income limits can impact somebody's ability to do conversions. Now, we have a whole seminar dedicated to IRAs versus Roths, but and all of our seminars are recorded. They're up on our website. Feel free to watch one of the old versions. We do cycle through some updates throughout the year as well. Now, the reason I spent all of this time talking about this is because it does introduce a planning opportunity while you're still working. The first one is what we call a backdoor Roth contribution. Now, it's a nickname for it, but what it is if you do not have an IRA account, that's the biggest part of this. You cannot have a traditional IRA account. Well, what you can do is actually make a contribution into a traditional IRA on an after-tax basis. And because we're doing it on an after-tax basis, it doesn't matter how much money you're making, because there's no cap on the ability to deduct if you're over the income thresholds. But you make an after-tax contribution into a traditional IRA, and then we immediately convert it out over into the Roth. This is a way, and we're limited again on the $7,000 contribution limit, but it's a way of getting $7,000 flipped over into a traditional IRA, over into a Roth IRA. Now, we're still in this window of time where we can actually still do a 2020 contribution as well as a 2021. So you can actually theoretically do $14,000 all at once. Now, again, the key here is you cannot have a traditional IRA. If you have a traditional IRA, that conversion piece is not tax-free. And so ultimately it kind of diminishes some of the benefit, if you will. I had a question come in. Why do you say you can't have a traditional IRA? I just answered that. Yeah, so what happens is when you do a conversion, they use what's called the pro rata rule. And so if you have a traditional IRA account, I'll make up numbers. Let's say your traditional IRA account is $7,000. And let's say you do another contribution for an additional $7,000. Well, now the total IRA balance is $14,000. The first $7,000 you had in there was pre-tax dollars. The next $7,000 you put in there is after-tax dollars. Now, when you go to do that conversion, only half of the amount that you convert is going to be considered tax-free. So ultimately, you can convert the entire amount, but only, again, because the initial amount was pre-tax, that's actually going to create a taxable event. Now, some people, they don't really, they're not always aware of that and the impact that it's having. So it's something that we want to be mindful of. A lot of times it's the non-working spouse where they haven't had 401k plans, they don't have IRAs, and it's a great planning opportunity for them to do. And I would also say, by the way, if you're thinking about leaving money to the kids, helping them do these IRAs and backdoor Roths early on when they might not have discretionary cash to do it is a fantastic planning strategy as well. All right, So that's the backdoor Roth contribution. There's also a strategy called the mega backdoor Roth strategy. And what we're doing here is actually the same concept. You can put an after tax contribution into your 401k plan and then immediately roll that out and move it over to a Roth IRA. Now, within, for example, the ExxonMobil plans, we like to do what are called tax paid withdrawals. Now, because ExxonMobil has discontinued their ability to have a company match, I'll go back to talking about those contribution limits. Remember, I said if you're over the age of 50, you can put 64,500 in. Well, I'd have you put the 26,000 in on a before tax basis, reducing taxable income, but you could put an additional $38,500 in and actually then have that go into the 401k and immediately withdraw it and move it out over into a Roth 401, excuse me, a Roth IRA. Now, other plans, other companies, some of them make you keep it in plan, so you have to move it to a Roth 401k. But remember, the whole reason this makes sense, and it might ultimately make sense for anybody who's got big tax paid balances within the savings plans already, is that after tax money that's growing in the savings plan, if it's still growing in the after tax account, the growth is on a before tax basis. Whereas once we convert it and move it over into the Roth IRA, it's now growing tax free. The other piece of this, because a lot of times as we talk about tax optimization, we talk about tax integration, these aren't decisions that we're making just this year. We're looking at the next 5 years, 10 years, 15, 20 years. And so for a lot of clients, especially if you're going to be in that scenario where required minimum distributions are going to be punitive to you, well, we really should look at the how are we saving and what is the impact that that's having on us long term. Because, for example, the money while it's growing on a pre-tax, the after-tax money while it's growing on a pre-tax basis, it's all continuing to be counted as part of the math in that pre-tax environment. And if you recall, those have required minimum distributions. Whereas once it's in the Roth, it's now growing tax-free. It's also not having, well, specifically the Roth IRA, it's also not having Roth required minimum distributions. So it's planning strategy. It's a great strategy. It's one that as we're sitting down and doing some planning work, happy to talk about your situation if it makes sense. All right, real quick, I just wanted to go through the investment options that are within, for example, the ExxonMobil savings plan. I think it's important, especially when we're talking about the accumulation phase of life, know where you can save, know how you're saving, and know what your investment options are. So within the ExxonMobil savings plan, there's the ExxonMobil stock, there's equity units, extended market units, international units, bond units, balance fund units, and then common assets. So ExxonMobil stock, obviously single stocks, highest possible risk. There is the opportunity for something that's called net unrealized appreciation. I have a whole dedicated seminar to this, but to kind of give you the cliff notes, NUA, it's a tax strategy. It's a tax strategy that if somebody left money across the street and all you had to do was go pick it up and go get it for you, you're going to look at doing it. And so the concept behind NUA is if you left everything in your 401k and you didn't do anything at all, well, when you take that money out, as we've already talked about, you're going to pay ordinary income. With NUA, again, it's a tax strategy. You're going to pay ordinary income on your cost basis to then get these shares out and only have to pay long-term capital gains off of the appreciation. So just to kind of quantify these numbers a little bit, let's just say, and I'll make it up completely, you've got $500,000 worth of low cost basis stock. And let's say the basis is 50,000. So you've got 450,000 of gain. Well, if you were to pull 500,000 out of your 401k, whether it's at once or over a couple of years, you're going to pay ordinary income off of all of it. With NUA, you'll pay ordinary income on the 50 and then long-term capital gains rates off of the appreciation. And so if you think about it very simplistically, all NUA is it's playing off the difference between ordinary income rates as well as long-term capital gains rates. And so it's important to talk about how this would have an impact long-term, because as we take advantage of NUA, we're going to move it out of that 401k qualified environment and over into a non-qualified environment. And so with 401ks, you put money in on a pre-tax basis. It grows completely tax deferred. When you obviously get the company match, but the problem really with 401ks is if you're under 59 and a half, there's a 10% penalty to take money out. You pay ordinary income on everything you put in, as well as what you take out. You also have required minimum distributions off of 401ks. So there's value in NUA in that it gets it out of a place where it's subject to penalty if you're trying to bridge your cash flow under 59 and a half. It gets it out of an environment where you're paying ordinary income off of it, but also it's getting it out of the math where you're going to have required minimum distributions. So this is just an example of a savings plan statement. Wanted to just highlight kind of these are the different options from an investment perspective where it's saving and accumulating. Now, one thing I didn't mention yet related to NUA is if you have this pre-87, post-86 contributions, this is the after-tax amount that went into the 401k. It is growing on a pre-tax basis. A lot of folks confuse the, hitting too many buttons. Confuse the pre-87, post-86, which is listed here at the bottom left, with the after-tax account. Well, the after-tax account is higher than the pre-87, post-86 because that's including the gain. But the basis, the pre-87, post-86, that's what we can use to offset for the cost basis on NUA shares, meaning it would actually give us the ability to pull shares out completely tax-free. So going back to that example where I mentioned a moment ago here, let's just say the cost basis is $50,000 and the appreciation is $450,000. Well, if you have $50,000 worth of that pre-87, post-86 tax paid, you would have the ability to actually pull all $500,000 worth of those shares out of the 401k tax-free off of the ordinary income component, and only obligation you would have left is then going to be to pay long-term capital gains as you sold the shares at some point in the future. Also related to this pre-87, post-86 is the same conversation we're going to have around mega backdoor Roth conversions, and if it makes sense to use that to go ahead and kick that money over into a Roth and have it grow tax-free. And this is where everyone's situation is going to be a little different. Let us help with the analysis and look at what numbers make sense for you. Now, one thing that's extremely unique about the ExxonMobil Savings Plan is that they have a record of every single share that's ever been bought. So it makes NUA a little bit more valuable for ExxonMobil employees simply because we're able to look and say, all right, these are the low cost basis shares. These are the shares that I'm going to target for NUA. I'm not worried about anything else. A couple other things while we're talking about the 401k. We always want to make sure that if you get over the age of 50, you put in your catch-up contributions. A lot of folks assume that because they're putting in a certain percentage of their income that it automatically will pick up that catch-up contribution piece. That's not true. When you turn the age of 50, you need to go in and actually add in a catch-up contribution. And we'd like to max it out. It's, as I mentioned before, $6,500 a year. So the only way you know you're actually making the catch-up contribution is you have a specific line item with a dollar figure, whereas the other contributions are based on a percentage. So just something to be mindful of, especially when you're getting close to or turning over the age of 50. All right, so a couple of the other things related to the investment options. The equity units are just tracking the S&P 500. It's the 500 largest U.S. companies. It represents approximately 70 to 80% of the market value of all publicly traded U.S. companies. Then we have the extended market units, which is approximately the Wilshire 4500 index. It's mid and small cap companies. It's an index that includes all publicly traded U.S. companies minus what's in the S&P 500. Then we've got the international units, which is tracking the EFI index. It's large and mid cap companies in 21 developed countries. There's currently 918 companies in the mix. It represents about 85% of the market capitalization in each country. Then we have the bond units. Now, bond units is tracking approximately the Barclays Corporate Aggregate Bond Index. It represents about 17,000 publicly traded bonds in the U.S. It's a mix of government, corporate, and mortgage bonds. It does not include high yield bonds, municipal bonds, inflation index bonds, as well as any bonds that are not denominated in US currency. Now, real quick comment on bond units. I am actually genuinely concerned about anybody who's keeping bond units within the savings plan right now. And the main reason for that is when I look at a client's overall risk profile, well, we've got to look at their assets in aggregate, which includes the value of their pension slash lump sum option. And it's important to remember, while you're still working, your pension lump sum is actually a big bond portfolio. As we talked about earlier, those discount rates, they're all tied to interest rates. And they're going to, and that lump sum is going to fluctuate based upon what interest rates are doing. It's important to remember that that is real money. You are going to have that money, and we need to factor that into the math. So those that are carrying bond units within the savings plan, well, we're first off, we're actually lowering your potential risk profile, and everyone's going to be a little bit different here. But we're also talking about an investment asset class that bond prices and interest rates move inverse to each other. So I do believe that with what happened during the pandemic and a lot of the relief initiatives, we've brought interest rates artificially low based on a lot of what the Fed is doing. At some point in here, the interest rates are going to rise. I already talked about discount rates, and they're starting to rise. Well, that's all based on interest rates. And that's going to make bond units a little bit more of a difficult investment for those in the savings plan. For a lot of the reasons, there's why I'm not a big fan of bond units in the savings plan. Now, balanced units. This is just kind of a one-stop shop option. You can put, it's got 35% in the equity units, 15% in extended, 25% in international, 25% in bond units. For the same reason I just mentioned before, not a big fan of balanced units, simply because it has a 25% allocation in bond units. But again, if you're just looking for one option, that's not a bad one. All right, and then common assets, this represents cash. It's got a dollar net asset value. The yield is variable. It's actually been a pretty good money market program over the years. It is higher than any money market we can find not within the savings plan. So it's definitely something to consider if you're looking for short-term parking place money. So when you're over a year out, we're real big on understand how much you're contributing, where you're investing, how you're investing. If you're putting money in on a before tax basis versus after tax, and then what your tax paid balance is, how to utilize, how to optimize that. Consider the mega backdoor if you've got some money sitting in there and you're not going to need it for NUA, as an example. All right, now related to that, we always like to talk about the pension. The pension, it's a real number. I love this slide simply because it's very old. It's from 2007, but it shows the formula right here. So we know, for example, the ExxonMobil pension program, it's 1.6 times years of service times average pensionable pay. There's a Social Security offset. This creates the single life annuity option. Now, from there, we apply the discount rates and boom, we get our lump sum number. It's very clean. Love this as an example. But one of the decisions that we're going to have to make at retirement is, are we going to take lump sum? Are we going to take annuity? Now, if you're under the age of 60, you have the luxury of being able to defer it and actually pick up some of the reduction that ExxonMobil would impose. However, that might not always make sense if you're going to take the lump sum, and we're seeing interest rates move up parabolically high. So again, we got to look at everything in terms of a more comprehensive strategy. But if we go with the annuity, we're now getting a fixed cash flow for the rest of our lives. The only criticism that I give ExxonMobil's annuity is that there's no cost of living adjustment off of it. And for some, that's totally fine, because you might have other assets to be able to use to grow and invest and not have to worry about cost of living adjustments. But that principal amount goes to zero. So one of the many decisions that we're going to have to make related to someone's retirement. Now, with the 401k, the default option is to leave it there. And I'm a big believer, leave the savings plan at Voya until you are very certain of what your strategy is going to be. Once you're certain, though, then go ahead and look at taking it out. You can roll a 401k to an IRA. You can do what's called a lump sum distribution, or you can roll it to an annuity. Now, that lump sum distribution, this is where you're actually able to take stock in kind. So if you have some of those low cost basis shares we were talking about for NUA, you can take those out, have those go into an after-tax account, And if you have any stock that's up above that price point, take those out, have those go to a traditional IRA. But lump sum distribution also has the option to take it all out as cash, making it 100% taxable. That doesn't always make sense. Or you can also roll it all over to an IRA, which that has no tax. And this is what the typical rollover would look like. You would see somebody would have some shares with NUA stock. Those will go out into a non-qualified account, whether it's a joint account, trust account, individual account. Then you'll see shares that are above that we declared for NUA. Those will go to an IRA account. And then anything that's in the non-stock investments, equity units, extended units, common assets, those will come out as cash and they'll go into a traditional IRA. If you have Roth 401k or some of that excess tax paid, that can all be rolled to a Roth IRA as well. Now, a lot of folks are doing rollovers really because it does give you the ability to have more investment choices. I would say that the big issues I have with the savings plan is that you have only the 6 investment options within the plan. We also only get the ability to do 2 trades a month, and you only get the average price the following day. Historically, leaving it in the plan was the best option because it was the lowest cost. But I'm going to make the argument that that low cost comes at a cost as well. For example, the ability to have more options, or even if you want to have a more strategic price point that you're trying to execute at. A couple of weeks ago when the stock ran up to $50 a share, we had some clients who said, hey, should we go ahead and sell some? We had that conversation. For those that were overweighted, we started talking about how much we wanted to sell. But the next day, the stock dropped 5% as an example. And so for those that were wanting to execute on it, well, they didn't get the $50 a share. They only got the average the following day. And so that can actually be detrimental. A lot of folks are doing rollovers, $22 million hourly, $548 million yearly, et cetera. All right, so the next thing I wanted to talk a little bit about, and this is partly how to build out your retirement income plan. And this is understanding what are the options you have available to you in order to be able to develop your income needs. The first is looking at Social Security. Now, we have a whole presentation on Social Security that I'm going to be doing next week, but Social Security was never designed to replace 100% of anyone's income whatsoever. For those that were at a lower income threshold, it would replace 90%. And for those that are theoretically have unlimited income, well, it's not going to replace any of it. But for the US median household, it was designed to replace approximately 40%. For the typical gas and oil employee, we find it replaces anywhere from 10 to 30%. And then the next bucket would be any type of pension source you have. Now, with the pension, it also never designed to replace 100% of anyone's income. On the low end, it was 12%. On the high end, it was about 70% of someone's earnings. And we already talked about the formula earlier, but it was, it's 1.6 times years of service times average pay. There's a Social Security offset, and there you go. Now, for the typical career employee, we find that at the age of 60, when they're retiring, the pension program will replace approximately 50% of what they're needing. So let's just hypothetically say the pension is going to replace 50%. Whoops. And let's say that Social Security is going to replace 10%. Well, that's only 60% of what somebody was making. That's obviously not enough. And that's where we then need to rely on savings and investment for the rest of it. And so this then builds out having a very good and concrete understanding of where your cash flow plan is going to come from, whether it's Social Security, whether it's looking at the pension versus an annuity. Then we'll want to have an approach dedicated for short-term liquidity needs. And then we're going to talk about investment strategies to help facilitate that, what I call the deaccumulation phase of life, where now you need to turn that bucket of money into a paycheck for you, whether it's using bond ladders, whether it's using income investments like a big dividend paying stock, or even something like covered calls, which again, covered calls are a option strategy where somebody will pay you for the right to buy your shares from you at a certain price at a certain date in the future. You cannot do these while you are still actively employed, but once you're retired, you now can. It's actually a very attractive income option for those that are trying to get a little bit more cash flow off of their shares as they're continuing to own them. So a lot here. And the other thing that I would say, especially as we're talking about preparing for retirement, but even in retirement, it's understanding tax and tax optimization. And in order to do so, the first thing you need to do is understand the tax implications of the sourcing of the money. So for example, Social Security, it's a portion is taxed as ordinary income. Pension income, interest income, IRA or 401k distributions, all taxed as ordinary income. Qualified dividend income as well as long-term capital gains, they're taxed at long-term capital gains rates. I'll come back to that in a second. Roth IRAs, as we already discussed, not subject to taxation. Same with liquidation of investment principal, also not subject to taxation. Now, long-term capital gains rates. We know our ordinary income rates go from 10% to 12 to 22 to 24 to 32 to 35 to 37. Long-term capital gains rates, at least under current tax law, which I do think tax law is going to change, but under current tax law, they actually go from 0% to 15% to 18.8% to 23.8%. And the point here is that long-term capital gains rates are always lower than ordinary income rates. And herein lies an opportunity. And let's say, for example, I'll go back to that NUA stock example. Let's say we pulled $500,000 worth of NUA stock out, had a $50,000 cost basis, $450,000 worth of gain. Well, I told you, you had to pay long-term capital gains rates. Well, here they are. And so part of the conversation we're having as we're building out someone's plan as well as their cash flow strategy might be, are there ways that we can bring their taxable income down so that we can get 0% long-term capital gains rates? And so with a little bit of planning, we're able to pay zero off of pulling that money out of the savings plan. It's a great strategy. It's something that you're really not able to do while you're working, but once you're retired and we can control where your taxable income comes from, it's fantastic. And so a lot of people will say to me, well, James, there's no way I could be in the 12% tax bracket. I said, well, why not? And they say, well, I need $150,000 a year to live off of. I'm making the numbers up. And you're right. At 150,000, you're at least in the 22% bracket. Now, I'm going to come back to you and say, just because you need $150,000 a year to live off of, that doesn't mean that we're creating $150,000 worth of ordinary income. We could have that money sitting in a money market account or a checking account, and we could turn that into our paycheck, the $12,500 a month. Just there it is, it's coming in. Well, we haven't created any tax on doing that. So now all we've got is dividend income coming off of some of our investments, but that's not going to drive us up that much. So now we can then look at incrementally selling to be able to go after some of these lower, more attractive long-term capital gain strategies. To me, when I look at potentially looking at hiring an advisor, planning's great. Their investments, they're going to be watching it more than you probably will be. Maybe not always the case, but it's the strategy work, the execution, the implementation, the tax work, the estate planning work. That's where I view an advisor should be adding the most value to a household. And we can quantify the dollars. Here's the amount of money that we're going to save in taxes. And so part of what we're doing with our planning work is we'll build the base case out, but then we're going to poke holes and find those optimization scenarios. What makes most sense? How do we make this better? Now, related to that discussion as well, though, is understanding how are we going to bridge the gap, especially if you want to retire early. Anyone who's going under the age of 59 and a half, you need to have a cash flow plan. And the reason, again, is because if you're needing to pull money off the pension, the lump sum, or off of your IRA accounts, 10% penalty to get the money out. So if that's the case, then we need to either have savings, we need to use the net unrealized appreciation to be able to bridge the gap. Might be part-time work or consulting work. It might be that we just leave the savings plan at Voya and you have the provision once a year you can take a distribution out penalty-free. There is a tax provision called the 72T, which means that you can actually turn an IRA account onto a private annuity. For 5 years, you have to take out the exact same amount of money, but it is an option for us that avoids penalty. And then lastly, we look at lines of credit. Now, I'm not a big believer in taking on debt to find cash flow. However, I could make an argument that borrowing right now at 2% to avoid a 10% penalty, especially if it's only just a short period of time, that might make sense. And so this is, again, everyone's strategy is a little bit different. You need to have a plan that's going to be able to pull all of this stuff together. Now, and with it, we're going to be looking at cash flow planning. We'll be looking at conversations like annuity versus lump sum. We're going to look at the NUA. We're going to build out some optimizations there. We want to evaluate current portfolio structuring, how you are invested, where you're invested. If you have too much stock, for example, we need to have a strategy in place for that at this point. We'll also want to talk about how to execute some of this strategy work now, even while you're still actively employed, like the mega backdoor Roth or a backdoor Roth. Those are all great things to look at. Now, when you're over a year out, a couple of things that I always recommend. If you're going to have an advisor, I think it's important to look at who you're actually trying to work with. The first thing to me in terms of criteria that you're evaluating is they have to be fiduciaries. And what I mean by a fiduciary is they have a true fiduciary obligation to you. Now, a lot of folks don't necessarily know the difference between a broker and a fiduciary. A fiduciary, they are legally obligated to put your interest above their own, extremely transparent in terms of how they're compensated. Whereas a broker, they can get paid commissions. They're getting incentivized for the recommendations that they're making. And I'm a big believer, if anybody's getting paid to sell me something, is it always in my best interest? Maybe or maybe not. I also think that any advisor you're thinking about working with needs to be a certified financial planner. I believe that they need to know your retirement plans as well as the IRS rules around it. And I think I've given enough examples today of how each plan is very, very unique. ExxonMobil plan, for example, has a lot of intricacies that if done incorrectly, we're making some lifetime long decisions here that will have a detrimental impact long term. We also believe that they can manage, they've got, over 15 years of experience, that they manage their own portfolios. They're not farming it out to some other money manager in some other part of the country, that they can discuss various different strategies with you, that it's not just the one thing that they know how to present. And then I also think it's really, really important that they track your performance versus your plan. I can't emphasize enough the need to have a plan. The plan to us is the baseline for a lot of the decisions that we're going to be making, but tracking the plan versus performance. And then lastly, are they good translators? Can you understand them? Now, changing gears a little bit, and I'm just trying to be sensitive of time here, but when we talk about right there, when we're less than a year at retirement, then we'll talk a little bit about at retirement and afterwards. But when you're within a year, this is the time to determine, refine your income need. If you haven't done so yet, consider hiring an advisor, having a trial account. Redefine your cash flow plan, especially if you're under the age of 59 and a half. Let's review possible investment options. We're also going to be now very closely monitoring what discount rates are doing and what type of impact that's going to have. Understand the timing and the execution. So for example, the year-end leave rule means that you have to be on the payroll December 31st in order to get your next year's vacation. So understand the economics behind a lot of the decisions that we're going to be making. Now, when we're at 120 days out, this is when you can first select your benefits package. Now, there's 3 critical dates here. You need to know your last day on the payroll, your first day of retirement, and your benefits commencement date. Now, the benefits commencement date is always the first of the month. The other 2 can change. One thing to note, for anybody that's in the non-grandfather category, meaning they were born after 1957, in order to get that quarter's discount rate, you have to have a benefit commencement date within that quarter. So for example, anybody who wanted the first quarter of 2021, discount rates, the last possible benefit commencement date for them was March the 1st of 2021. And same goes if you want the second quarter, June 1st of 2021. If you have an April 1 to a June 1, you would have the second quarter discount rates. Now, this is when you can request your intent to retire package. You'll need to inform your supervisor, in writing of critical dates. You'll have to submit any type of pay in lieu of vacation if applicable. This is always when you want to receive and return the intent to retirement package, plan your retirement party, turn in your laptop, your badge, and mobile device. Now, with these retirement packages, I'm a big believer. You want to have your advisor with you going through this package. We're making some irreversible life decisions here. But the intent to retirement package is directly related to the pension benefit. There's some information in there about your health care, but it is really about the decisions we're making for the pension. Now, with this, we're going to be completing the forms. We're going to select lump sum versus annuity. If we're taking the annuity, we select which type of annuity and how much tax withholding we want to do. If we're taking a lump sum, we need to select the IRA custodian. Now, in that package, there's also a document in there called the special tax notice. I always highlight that so that anybody who is going to ultimately be looking at the savings plan as well, you'll need to be able to certify that you've read that. Now, within the package, there are 3 places that need to be notarized, 2 by the participant, 1 by the spouse. If you're single, it's only 2. And then if you are fortunate enough to have a supplemental pension plan or an additional payments plan, you're an executive, there's an additional place that needs to be signed and notarized. Now, this package needs to be back 35 days prior to your benefit commencement date in order to have everything processed on time. So there've been a little bit of leniency with the voluntary retirement program and folks looking to go, but that's one to be mindful of as we're building out that roadmap and when we need to be executing things. Now, we do get asked the question a lot, when should I consider delaying taking the pension? Well, first off, if you don't need the money right away, that's the base case. Second off, if you're retiring before the age of 60, and I'd say third off, if you're taking a lump sum and you expect interest rates to continue to go down. Otherwise, we really should look at the economics of the decision on delaying it versus the opportunity cost of how it would otherwise have been invested. And everyone's going to be different. Their risk profiles are going to drive a lot of that discussion as well. Now, when we get to that point when we're right at retirement, this again is where we want to talk about the savings plan rollover. Now, as I mentioned earlier, you are not required to do a savings plan rollover right when you retire. There is actually no clock that says you have to do it then, but it's something that we want to make sure we're having these discussions on. And so first thing is we always say make no withdrawals or Roth conversions prior to doing a rollover. Only do the savings plan rollover when you're very clear on your overall plan, whether it's your cash flow plan, your NUA plan, understanding the tax implications, the estate planning, and the investment plans. And then we want to go through and we'll review the call with you. Now, when it comes to the call to Voya, another thing that I would want to make sure your advisor is on the line with you. I will tell you from my experience, Voya has gotten better, but my typical experience is that the 60 to 70% of these things have mistakes. And so I think it's very, very important to make sure that somebody who knows this process, again, we're making some irreversible tax decisions here, make sure that you're integrating that in your plan. Now, typically it takes about a week after retirement before you can do these rollover calls. This is where I'll walk you through the entire call. The first thing when we get on there, Voya is going to verify that you're eligible. If you had a qualified domestic relations order, you were divorced, then there's typically some delays there. I've had a few of those this last couple of weeks. Now, once we get on the line, the only thing that you're going to need in preparation for that is your verbal authentication PIN. It's a 6-number PIN that you should have. If you don't actually have that, there's 2 ways of going about getting it. One is you can call them and request them to mail it to you. The second is you can actually go log on to the Voya website, not through single sign-on. This is the most critical part. I've learned this the hard way. But if you log on a personal computer, top right corner, there's a box that says security profile, or excuse me, user information. If you go down to security profile, it's right there. They can actually text it to you so you can have it to be able to do it a little bit quicker. Now on that process, the representative is going to ask if you've read and received the special tax notice, which if you recall, we had talked about on the when we completed the intent to retire package. But they're going to ask if you've read and received that and if you waive your right to wait 30 days. Now, if you don't say yes, then the whole process has to stop and you have to go back, read it, and then start it over again. But within that, we're going to tell Voya what we want to do with your stock, specifically if we're going to declare NUA or not, what we want to do with any of the remaining shares. Then we're going to tell them who the IRA is for any of the pre-tax money or custodian is for the Roth money, and then what to do with any of that after tax. Now, once we go through this with the first representative, if we're lucky, we don't have to get transferred to a distribution specialist, but more often than not, you do. I found these calls on the quick end is about 45 minutes right now. I've had a couple go over 2 hours in the last couple of weeks. So just be patient, but it's part of the process. Now, in terms of setting expectation, the pre-tax assets, all of the cash portion, you can get that as quickly as a week later. But the stock, if you're moving shares over, they have to go through a transfer agent called Computershare. Now that transfer agent, they have to send the shares to Computershare, then Computershare has to generate a statement. That whole process can take 4 to 6 weeks to get the shares moved. That's been a little bit of a surprise for folks that it's taken so long there. But that's the essence of the rollover call. I did cover a lot today. And, I would say that if you haven't taken us up on the opportunity to sit down and run the numbers, please feel free, reach out. We're delighted to be a resource for you. Absolutely no cost, absolutely no obligation. I do have some events coming up over the next couple of weeks. On the 24th, I'm going to be doing the Social Security and Social Security Planning Strategies event. On March 3rd, I'm going to talk about how discount rates affect the lump sums. And then on March 10th, I'm going to be doing one on retirement income planning. So please feel free to join. Again, we're going to have those recorded just like I had this one. Here is our contact information. If you have any questions at all, please do not hesitate. Delighted to be a resource. Thank you for taking some time to watch today. And don't hesitate. Most importantly, stay warm, stay healthy, stay safe. Talk soon.